This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
We're living in a world where supply chains have been disrupted over and over again. There was COVID, there's wars, there's geopolitics coming into play, and the technologies are outdated.
Hi, everyone. Today we're diving into a part of the climate transition that doesn't get nearly as much attention as solar panels, EVs, or AI. It's the materials, minerals, and manufacturing systems that make modern civilization possible. Steel alone accounts for roughly 7 to 8% of global greenhouse gas emissions, and the energy transition is driving unprecedented demand for critical minerals, advanced materials, and domestic manufacturing capacity. These sectors offer incredible investment opportunities, and that's the focus of my guest, Kavita Patel. Kavita is a portfolio manager for venture investment for MUUS Company. MUUS is the family office of Tiger 21 founder and chairman Michael Sonnenfeld and his family. We discuss opportunities ranging from critical mineral recycling to next-generation building materials, what she's learned investing through the ups and downs of climate tech, and why she believes some of the most compelling opportunities today may be hiding in sectors many investors overlook. We also explore where climate capital is flowing, where it may be underinvesting, and how investors can think rigorously about both financial returns and real-world climate impact. I learned a lot from this conversation and think you will too. Enjoy. Hello, Kavita. Welcome to Invested in Climate.
Thanks for having me, Jason.
This is our first time chatting, so before we dive into the work that you're doing now, I'm excited to learn a bit about you. I just learned that you're from Illinois. You're now in New York City. It looks like you've worked at the intersection of climate and finance really for most of your career. What got you interested in climate investing to start out?
Absolutely. I would say the through line of my career has really been a mission to drive inclusive economic growth, and that really stems from my family background. My family is from emerging markets in South and Southeast Asia, as well as East Africa. And growing up with that lens, I was really interested in what drives sustainable and inclusive economic growth globally. And at the same time, I knew that climate change was disproportionately affecting those in emerging markets. And I wanted to be part of investing in the technologies that could be leveraged for the future. I've had the opportunity to work actually at the Stock Exchange of Thailand, which is a really formative experience for me, understanding how important financial systems are for economic growth. And that's what led me into pursuing finance first at BlackRock, where I was covering insurance companies. And it's hard to avoid the impact of climate change when you're covering insurance. And so while I was at BlackRock, the Hurricane Harvey had hit, the California wildfires were becoming a lot more severe, and insurers were worried not just about their policies being written in climate vulnerable areas, but also about what climate risks there could be within their investment portfolios. And so I started diving in to do everything from stranded asset analyses of coal plants, ESG trade programs, and even full 2-degree alignment of portfolios for insurers. And that's really how things started snowballing into focusing on climate specifically and working on everything from green bonds to renewable infrastructure, I knew I wanted to be on the cusp of where innovation was happening. So that led me to get my MBA at MIT Sloan, where I focused on entrepreneurship and climate finance. And through that, I actually met the MUUS team where I've now been for the last 5 years.
Fantastic. And you also spent 4 years at BlackRock. Was your work there focused on climate, or did the time there somehow inspire your move into climate venture?
It started out as general asset management, but I was primarily covering property and casualty as well as life insurance companies. And I think when impact investing or sustainable investing first started out, the initial evolution was mission based. It was people wanting to avoid coal, oil, and gas, similarly to how investors have avoided tobacco or firearms for some mission related reason in the past. But eventually, what it had turned into during my time there was a risk reducer or alpha generator. And this is where we get into the world of ESG factors and looking at resource efficiency. And the thesis was companies who are using their resources efficiently, whether that be reducing carbon intensity, improving water efficiency, that's simply a proxy for the operational efficiency of a company and their long-term profit trajectory over time. So it was a really interesting time to be there during the rise of ESG and seeing how sustainable investing permeated all asset classes at the firm. Ultimately, I felt like I wanted to be more where the innovations were happening. I wanted to be directly investing in the most impactful companies. And so my path led me to venture.
Fantastic. And so now you are managing a portfolio of venture investments at MUUS Company. Will you tell us a bit about MUUS Company and your investment thesis when it comes to climate?
So MUUS is an entrepreneurial private investment company. Serial entrepreneur Michael Sonnenfeld is the founder, and Michael has a 40 plus year entrepreneurial career, starting out in real estate, becoming the chairman of a public solar lighting company in the 1990s, so strong clean tech 1.0 experience, and most recently as the founder of Tiger 21, which is a peer-to-peer network of exited entrepreneurs like himself. So MUUS has a very strong entrepreneurial and creative deal-making backbone as our ethos. And we've been investing in climate and indeed have climate activities between philanthropy, political involvement, as well as investing activities since the 90s. So it's a very core to Michael's ideology. And we've built out this climate tech portfolio for the last 10 years now. The thesis is to invest at the convergence of advances in advanced technology, such as 3D printing, physical AI, that are tackling decarbonization. And that's another way to say that we invest in the entire economy. Climate tech now is permeating energy systems, the way we move and get around, the way we're manufacturing physical items. And so we really like to focus at the cusp of commercialization, which is when you have your initial customers or a pipeline of customers that you are ready to deploy with. And it's really high integrity founders that are commercializing B2B innovations with a strong moat. And given the background, we've leaned towards companies that are operating in the physical world across renewables and grid innovations, AI-driven infrastructure plays and manufacturing, as well as industrial efficiency and manufacturing.
Kavita, MUUS has recently done a ton of investment in the materials science and minerals and mining spaces. Tell us more about those opportunities and why you're bullish on it.
Pretty much everything to do with the energy transition requires all these critical minerals: batteries, solar, wind, data centers, transmission. all requires very large quantities of lithium, copper, nickel, rare earths, and traditional mining simply cannot keep up with the demand. It's partially due to long development timelines, it's partially due to declining ore grades, but there is a structural supply gap in the market, which means we are limited in meeting the demand for all of these renewable technologies. And beyond even critical minerals, the material and energy supply chains that we have today is because they were convenient, they were abundant, and they were cheap. And those same inputs, you can no longer say that that is the case today. We're living in a world where supply chains have been disrupted over and over again. There was COVID, there's wars, there's geopolitics coming into play, and the technologies are outdated. So, MUUS is bullish on technologies that are increasing the supply of these critical inputs and technologies that are increasing our domestic manufacturing capabilities, whether that's through efficiency, whether that's through reuse of materials that come into our borders, whether that's through substitution.
Materials, minerals, mining, not really the sexiest category, not one that you hear as much about, and suggests that maybe it's underhyped, creating an opportunity for investors to come in and find great companies with less competition. Tell me about the state of the market and investing in this particular space.
Yeah, I think we've been hearing a lot about the AI boom and data centers, and historically, venture has been a very software heavy world. I think now, given the SaaS apocalypse earlier this year, as well as the number of energy and supply chain disruptions that we've all experienced over the last 5-10 years, there's a real opportunity for companies to think about energy security as national security and think about domestic manufacturing and critical minerals as part and parcel of that thesis. So, macro, this is why we are operating in the physical world, because software can only solve so much, and it definitely has a role to play in our portfolio. But our manufacturing related companies have really stood the test of time despite all of these disruptions. And I can think of at least 6 companies in our portfolio, which, despite the passage of the Inflation Reduction Act and then the rollback of large parts of that, have stood up and are online with manufacturing in the US, making our supply chains more secure, creating jobs, and really decarbonizing the US economy.
You mentioned withstanding the test of time, and let's talk about time because the alignment of the venture model to software is a well-trodden, well-known path, and the timeline works really well. If we look at clean tech 1.0, or we look at things that require more hardware, more infrastructure, the timelines don't always match, and it sometimes takes more patience for investors. And I'm curious, in this particular space of material science and mining, what are you learning about the timeline for being able to provide returns on your investments?
Yeah, there's a few things there. First of all, I think the capital stack has significantly matured since Clean Tech 1.0, and you no longer have to finance everything with equity and have marginal dollars for VCs competing with software that's going to scale up quickly versus physical innovations, which may capture more value over time, but will be too dilutive in order to get there. The second thing is a lot of inputs have come down in cost or become more efficient because of these new technologies. So, for example, investing in battery innovation, or even for those at home that were looking at electric vehicles or backup power in their homes. Even in the last 5 years, battery prices have come down to a point where a lot of these innovations can compete at scale with the incumbent solution in the market. So your innovation needs to have such a significant cost advantage that by the time it gets to market, it will still be a significant disruptor despite other technological cycles that are happening at the same time.
Kavita, let's make it a bit more tangible. I know that you mentioned that there's 6 that come to mind of your investments that have withstood the test of time. Maybe we don't have time for all 6, but share a few investments that you've made that really you think exemplify the thesis.
Absolutely. Nth Cycle is one exciting company in our portfolio that really has the potential to become a linchpin of American critical mineral domestic supply chains. They have traditional metals refining right now is hydrometallurgy or pyrometallurgy, and it's using corrosive chemicals or using high heat in order to separate metals to get all of the nickel, cobalt, lithium, manganese compounds that we need to go into all of the grid infrastructure, solar panels, etc. And that's why we've outsourced a lot of this mainly to China. And there's not a strong metals refining presence in the US today, which is really constraining our capabilities for fast deployment. And from a national security perspective, we have this dependency on China that we would really like to move away from. This thesis has become more pronounced in 2026 and over the last couple of years, but we first invested in Nth Cycle's Series A back in, I believe, 2022. And the company and CEO and founder Megan has developed a electro extraction technology that reduces both the cost and the GHG input of refining these metals. So they like to talk about it think of it as a oyster technology, where they're using electricity as the input in order to get very high purity metals out of this process. And not only can they use this at virgin mines with low ore concentrations, but they can also take in end-of-life materials. So now we have all these electric vehicles and batteries, et cetera, in the US. We don't have to rely on China if we can upcycle things at the end of life. And Nth Cycle can take in black mass, which is essentially the crushed up batteries, and purify it through its oyster to input materials to be used over and over again. So it's a reuse circularity play that reduces the US dependence on China, and we can have our own critical mineral supply chain. And very excitingly, Nth Cycle actually announced a $1 billion 10-year offtake agreement with Trafigura, which is a metals trading company. And this is the largest multi-metals agreement between a recycled feedstock supplier and a critical minerals refiner. So it's really exciting to see the journey that they've been on and the scale up and buy-in from incumbents in the market that they have.
Super exciting, particularly the circular approach, which reduces waste and makes what can be a dirty business of mining, particularly from virgin mines, less extractive. And I'm curious, given the mining materials focus, what about the sustainability and the environmental impact of the industry overall? Are there any investments that you've been able to make or types of companies that you're looking for, opportunities that you hope to explore related to that sustainability or just the environmental impacts of mining itself?
Absolutely. I think mining is a tricky one because virgin mining, can be extremely extractive and have strong ecological impacts. And so we have looked at technologies for better identifying mines, as well as drilling technologies that are more efficient, use less water, etc. I think this Nth Cycle investment fits more squarely within the thesis, and there's less trade-offs or considerations to be made because it is a recycling play. And so you don't have those ecological impacts. You're actually reducing the need for as much mining of low-grade ores by being able to reuse. I do think that both ultimately will be necessary given the demand for these inputs. as we go through the energy transition, but we so far have stayed in the recycling part of the value chain for the very reason that you're pointing out.
Great. Any other companies that you want to highlight?
Yeah, I think going beyond just critical minerals and recycling and efficiency technologies, substitution is really exciting. So, we make all of these assumptions about, oh, you have to use concrete for this, you have to use metal for this. For example, one of our companies is called InventWood. They also have domestic manufacturing up and running in the US in the last 24 months. And it is essentially a wood replacement for steel, which blew my mind when I first heard about it. It is a wood-based material that is 80% lighter and 50% stronger than steel, and at scale can be at a discount to steel production. And so there are many ways to go about decarbonization. Steel production requires very, very high heat, and that is why it's so emissions intense. And a lot of people are focusing on decarbonizing industrial grade heat, which is important for several processes. But what if instead of decarbonizing the heat in that process, we just don't use steel anymore? It's kind of like gets rid of the problem entirely. And so InventWood has basically a next gen building material that has fire resistance, light weighting. It's actually even bullet resistant as well, and can perform as well as steel. And it's a cellulose based nanotechnology company. That's where their core innovation is. So you can do a carbon store via the wood, in addition to replacing the carbon intense process of creating steel. And it's just visually more appealing as well. So there's several win-win-wins. And I think one of the big learnings you have seeing all these cycles in venture is that you have to solve a top 3 pain point. You cannot have a prolonged green premium, and you cannot rely on consumer sentiment. So we're looking for bread and butter B2B based companies with strong IP moats that can compete with the incumbent solutions out there in a price competitive manner.
Kavita, so much has changed in climate investing in recent years. What's your sense on where capital is actually flowing versus where perhaps it should flow?
For better and for worse, we are in a completely load growth obsessed environment right now, driven by AI and data centers. And I think the clean, firm power is back in vogue. There's a lot of money going towards nuclear and geothermal right now. In addition to that, grid tech, which was a very sleepy area, is now getting a lot of attention. And for example, we have a company called Utilidata, which makes smart meter technology. And previously, going through a utility sales process took a very long time, but there wasn't that much load growth in the country. And so there wasn't this forcing function for change. But now you have these nimble tech companies where energy and electricity is their main bottleneck. And we're seeing a lot more collaboration on capital projects and grid modernization. So I love to see the modernization of the grid and a more forward-looking partner for what has historically been a sleepy industry. I think if there was something I would add to that, speed to power is the name of the game here. And I do believe nuclear and geothermal have their place in that system. But I think distributed energy resources are really not getting as much love as I wish they were in this moment. When you talk about the fastest marginal way to deploy, to add flexibility to the grid. It's going to be the systems that commercial and industrial businesses or even residential systems can install. Like, let's use the technology that we have that's commercialized and market ready today and figure out a better way to deploy them where it's most needed, while we're also working on these farther out innovations.
Kavita, it's been great to hear about some of your insights to the space overall. I'm curious, as an investor, what have you learned? You've been doing this for quite a while now. You've worked with a wide range of companies in different spaces. What are some insights that you've gathered as an investor?
Absolutely. The last 5 years has been major ups and downs in the industry between capital markets, policy, and supply chains as the major three factors that have led to the highest highs of the largest climate legislation ever passed in the US, to not really being sure if there would be government support for a lot of the climate technologies that we're backing. And so I think what's really struck me about the industry the last few years has been the resiliency of the founders and how scrappy and resourceful they can be. And that's really what has kept me both inspired as well as gives me confidence in the founders in our portfolio. And a topic that comes up again and again is backing CEOs who are proactive leaders and who act as chief resource obtainers. Their job is to attract the best talent, attract smart capital to the table, and attract customers who are really going to scale their technologies. And with all of the disruptions, we've had founders who have been very successful in buying up assets secondhand or finding facilities or assets that were in a distressed state to essentially find very capital efficient ways to scale up. We've also seen founders go through tough capital stack situations where grants were promised either by the Canadian government or the US government, and they found innovative ways to continue to finance, whether by reaching out to state policy holders in order to unlock some funding or sell tax credits that they had received, or even reach out to equipment manufacturers in order to get financing directly rather than reaching out to debt providers who maybe weren't as active in the market that year. I think the flexibility that I've seen across our portfolio has been really incredible. And I'll even extend that to M&A conversations as well. So we've seen companies find homes that maybe weren't the most obvious landing pad for them, but they were able to position the technology in a way that became a broader platform that wasn't just applicable to the slice that it was focused on, but was adding value to other ecosystem players. And so the ability to get creative about the capital stack, to garner unique partnerships, and to continue to demonstrate your value add when customer preferences are changing has been really incredible to see from our founders over the last few years.
And what about the earlier stages of that capital stack? What do you think founders get wrong about climate tech fundraising, and what advice do you want to offer?
Yeah, the areas where I've seen founders stumble is really two-pronged. The first is venture funders don't expect everything to go right. But we do need to see that not everything needs to go right in order for the business to pencil. The CEO doesn't need to have everything figured out, but we need confidence that they have identified the gaps either in their own skill sets or in the business and have thought through how those gaps are being filled. And that's why investors ask questions around margins, around cash burns, around exits. it's not saying we're investing in your seed. Why are you asking me about my exits? These are really questions about, okay, what's the margin of error here? How many things can go wrong and we would still have a really compelling business to move forward with? And the second I would say is really time is money. No one knows this more than founders, but I think sometimes there is a human nature to wait too long to launch a fundraise or an M&A process in the hopes that some commercial or technical milestone will be achieved and it'll completely change, what the fundraising landscape is. But if it doesn't happen or doesn't happen in the way that was intended, and you're now running on a short runway fuse, founders can lose leverage that they once had in terms of time and runway, that if they had taken the leap earlier, we would have been able to maximize optionality. So just a word of caution, like we're seeing a lot of dual and triple tracking. That's the push and pull on a board, is the founder wants to be laser focused on achieving X and the board is asking for Y and Z, but it's typically because that optionality can make or break what a successful outcome looks like. And at the earliest stages, it's good to remember that technical progress is not a substitute for business progress. And sometimes what we see is founders are generally quite technical in climate tech. And oftentimes technical problems can seem more solvable than convincing someone from a human aspect either to invest or become a customer. And so there can be more weight put on technical progress when there's not enough progress on the business side, instead of doing that, taking stock of gaps and either making the business development hire, getting a board of advisors, changing the pricing structure in order to make sure that commercial journey is moving along in a way that would attract more capital to come in.
Kavita, we've circled around the capital stack several times, and I'm curious how you all think about partnering. And are there particular family offices or other investors or institutional folks that you like to partner with, and how do you find them?
Absolutely. I think we have a benefit of being able to be very flexible and not having time pressure in either direction. We are thematic investors that are looking at secular trends such as onshoring of domestic manufacturing and critical minerals, as we had mentioned before. And we don't have a typical 10-year venture timeline pressure to deploy and then do or don't have a certain amount of reserves for follow-ons. So the type of partners we look to have, and I think the balancing act that founders go through is there's often seed and Series A stage investors, and then there's a different group for graduating beyond that. And having a coalition of longer-term permanent capital vehicle investors, family offices, or even strategics who are coming in can be really important to get through that gap. I think also being proactive about non-dilutive financing at the same time that you're raising that equity cushion is really important for extending runway. And we've seen quite an explosion of equipment finance, grant financing, OEM financing, in-kind services from corporates around the table in order to make these things work. And we've also seen figuring out what proof points they can knock out before needing to build a huge first-of-a-kind facility. So instead of having a facility, can you mount your widget on a skid and rent out your product at the customer site and charge something weekly to get buy-in and the technical milestones and the pricing proof points figured out in order to unlock that financing. So I'm really pleased at how the capital stack has evolved. There's still no roadmap to success, and there's still a gap in the scale up from pilot scale to first of a kind facilities. But for those critical innovations, despite all of the changing regulatory landscape, we have seen good partnership in order to continue to make sure that the best innovations are making it through that scale-up stage.
Kavita, let's close out with a question around impact. You're pursuing returns that are clearly not just financial in nature, but also impact related to climate progress. I've hosted some great conversations recently on the need for more rigor in pursuing and measuring impact. From your perspective, what does impact plus returns actually look like in practice?
I love this topic. I'm personally very committed to emissions reduction, and that's why I'm in this space. Earlier in my tenure at MUUS, I initiated our effort to be able to quantify the potential future impact of our companies and to be able to do this on an apples to apples basis without putting undue data burden on these early stage founders. And so we leverage a tool called CRANE, Carbon Reduction Assessment for New Enterprises. And essentially what it does is our North Star is decarbonization, even though there are many other water purity, reducing toxicity, et cetera, things that you can focus on. For us, it was easier to have that North Star to really keep us honest. And so what we can do via CRANE is look at the carbon intensity of the existing incumbent solution, the carbon intensity of the new technology that we're looking at, take the delta between those two to get a unit comparison, and look at, okay, 10 years from now, if this company really scales, what market share could it get and how large is the market? And what I love about the CRANE tool is that it's based in International Energy Agency data and other technology and life cycle analyses. So having the third-party validation without having to have a pre-seed or seed stage founder do the deep dive into a full life cycle analysis ensures that our marginal dollars are either going to technologies that have a huge potential impact or are decarbonizing in a smaller market, but a very hard to decarbonize area. So the way that we benchmark ourselves is about the average portfolio company's emission reduction potential. With each additional fund, we want that benchmark to move higher. But the reason it's not on a company by company basis is because there are some smaller markets that have very high emissions problems with not that many people working on solutions. And so we want to be able to leave room to invest in technologies that are really moving the needle in carbon intensive industries that are just super hard to decarbonize.
Kavita, thank you so much for this conversation. Great to learn about all the work that you're doing. Best of luck.
Thank you. Thanks for having me.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.